Alex Cole, my dear friend, welcome to the Go No Go show here on October 20th, 2022. How are you doing today?
Doing all right. How are you?
Yeah, doing well. Seems like the markets have been haunted. High volatility moves in all directions. You and I were just chatting last night. Oh, a little less than a 1% down day on the S&P, negligible, right? Given how volatile markets have been.
We used to, I remember we used to in Bloomberg, we used to screen for days that were over a 1% move.
Yep.
Because those were sort of significant. But these days,
we're back to the
dime a dozen, as they say.
A dime a dozen. Well, let's dive into a couple of interesting individual securities moving on some earnings announcements. Today's episode is about how earnings do not equal trends. But let's take a look at the chart of Netflix. First of all, reporting earnings on the 18th. Big upside surprise, about 3.11 was their earnings per share, and way above analyst estimates. But from a technical perspective, Alex, what are you seeing in terms of trend and this breakout of a major resistance?
Yeah, I mean, Netflix is something we've been watching for, you can pull the chart back and see how long we've been watching Netflix, because we kept having this no-go that was so durable, so persistent, gapping down, people saying there's no way it can go lower, kept going lower. But what these gaps provide, if you're familiar with traditional technical analysis, are levels of support and resistance. And as we made this long basing pattern that we eventually came out of into go trends, anybody looking at this chart who's had any kind of technical analysis background will see the resistance that this was going to run up against from the bottom of the gap back in April. So this massive gap down was going to provide resistance, and you can see how it did, for months. And you ran up against it, came back, ran up against it, came back, causing the GoNoGo trend to become unable to paint consistent trend colors. And then we're watching the oscillator, lots of volume around here, lots of trading. You see how the volume is, the oscillator's dark blue, telling us that there's lots of volume. And then this last time, running up again to that resistance level, we see a fresh break above the zero line, a quick retest, and then a really sharp move into overbought territory on heavy volume. And we finally clear that resistance level and gap higher. So not just sort of run up against it and try to push through. We gapped higher yesterday after the earnings on the 18th that were reported after the close that, like you said, was a significant beat of analyst estimates. And now, we know really that the other part that about gaps, if you've done any kind of technical study, is that gaps also are likely to be filled. So we know that the top and bottom of these gaps were going to be support and resistance. So that's a good thing now going forward. You've got a natural level of support here that you could set stops at. We know that around 250 now should be support. That also ties into the concept of polarity. What once was resistance will become support and vice versa. So this was resistance over and over and over and over again, and now is likely to provide support. Should price come back to it, investors will look at this level as a sensible place to get back in. But the other thing that I mentioned about gaps is that they are likely to be filled. So you now have a very easy to define target level.
Right around that 330 level,
gap around 330 as a target level. So even if you were to get in, around where we are now, 270, you've got a $20 loss versus a $50, a $60 potential target. So that's a good risk reward ratio. And you can see how using traditional technical analysis really, really works well with the GoNoGo charts, because you've got this entire price panel to look at. And then you can also add to all of that what we know to be true, which is that we are now again strongly trending with bright blue bars. Oscillator is on heavy volume, bursting into positive territory. So you add all that together, and I'm really loving this setup for Netflix. Now, of course, we could a week from now be talking about Netflix back down at 200. You never know, but
right. Prepare for both scenarios.
Having an intelligent framework within which to launch an investment, I think, is the way to go, and manage your risk accordingly.
Absolutely. Let's switch gears to a chart of AT&T, another earnings surprise. But as the title of today's show suggests, earnings do not equal trends. So right now we saw a huge upside move, 9% on AT&T after that upside surprise in earnings. What are we seeing in terms of a trend? I'm seeing neutral or go fish bar here on this this massive move higher.
Yeah, another really good looking chart from a go no go perspective. We see this no go that was in place, making lower lows, lower highs, and then this second piece of the puzzle for us, which is always where is the oscillator, and is the oscillator able to confirm or stay in line with the trend? And you can see how here we get rejected at the zero line, rejected near the zero line, rejected at the zero line. So when a no go in place, an oscillator staying at or below zero is what you'd expect in a healthy downtrend. So not only did we see this trend color change to an amber go fish bar, but actually yesterday, today as well, the oscillator bursting through that resistance at zero to confirm a fast move in price. So you've got a little bit more telling you now that this no-go trend is over. We're uncertain as to in which direction we go next, but momentum is in positive territory.
Fantastic. Let's do another one. IBM up about 4.5% after an earnings surprise. Still a similar trend configuration, a series of lower lows and lower highs.
Very similar to the chart of AT&T. This amber bar taking us above this short-term high, and we are breaking into positive territory in the oscillator on heavy volume with this amber go fish bar. So, trend uncertainty, but trend change happening as we look at it.
Absolutely. Let's look at Union Pacific Railroads. We saw that they beat analyst earnings estimates, but still fell another 4% after revising their annualized revenue projections. Seems like we're in a strong no-go trend to me, Alex.
Yeah, this is really where you can lean into positions, and technicians are very good at that, as opposed perhaps to people that take a more fundamental view of the market, because they beat their estimates. They had a positive earnings surprise, but that's not what the chart is telling us is happening with price here. There's something probably more worrying going on. And you can see that the oscillator was rejected by the zero line, no-go trend still in place. So this icon here is telling us that we've got continuation. We've got no-go trend continuation, and you've got that fresh rollover of the oscillator into negative territory, and we're moving lower to sort of test these this low from a week ago. So when you beat earnings and your price, falls over like that, then it was either priced in already and people were expecting higher, and they didn't get it. So there's something going on there that makes us, you're pretty confident in this as a no-go trend still.
We talk a lot about the combination of fundamentals and technicals within the CMT Association. We talk about that gap often between price and value. And certainly there's a pretty big signal here when a company beats its earnings estimates and still plummets. And so we know that the fundamentals alone are not going to give us a clear picture. Even if we knew, had a crystal ball and we could say exactly which companies were going to beat earnings and by how much, you don't know how the market is going to react to that news. And so following responsibly what the market is giving us is probably the best path for all investors.
Yeah, and that's technical analysis for me, right? Like the CMT talks about navigating the gap. Well, the gap is technical analysis, it seems to me, right? The fundamental value of the company is what it is. But that gap between that value and what it trades at, that's investor psychology, it's human emotions, it's excitement, it's fear, it's greed, and that's all technical analysis. And that's why, you really need to be careful. You can be convinced that the value of this stock is twice what it is, but it's not trading there yet.
Right.
That's
right. Those high conviction trades that become investments as we hope that they come back in our direction. Not a responsible risk management approach. Hope is not a strategy, Alex. So let's step back up to the 30,000 foot view as we often start this show with a cross asset heat map, just looking at globally what the nature and structure of trends are across the asset classes.
We're still where we were last week. We've got no-go trends in equities, in treasury bond prices, and in commodities. Commodities rolling over to a stronger no-go after having several bars of uncertainty with the amber go fish bars a week ago, now rolled back over into strong no-go. And the dollar, look out, back to strong blue bars. Just won't stop, the dollar.
Yeah, I did a small segment for Money.net Live earlier today. A lot of conversation about cash on the sidelines, about investors looking to put cash to work, and certainly from an asset class perspective, we're still seeing the U.S. dollar outperform as a safe haven in this market volatility. Alex, you mentioned in that second panel Treasury bond prices on the TLT, long-term U.S. Treasury bonds, continuing to sell off, which is inverse to the yield. So let's look over at the TNX 10-year Treasury yield, up around 4.18%. We haven't seen these levels since 2008. So talk to us a little bit about this go trend that seems very durable and very persistent.
And you got to keep in mind what these macro drivers impact. And for all the people that after that massive day 2 days ago in equities, we're talking about, okay, that's a really huge positive sign, that's putting in a low and all the rest of it. Well, we know rising rates are headwinds for equities. We know a rising dollar is a headwind for equities. So while they're out of line there. If the equity market's going to be off to the races, we wouldn't really be expecting rates to be making new highs. And again, this is narrative, but the charts tell us that we've got new highs in rates, strong uninterrupted blue go bars after this trend continuation icon, because the oscillator found support here at the zero line. So new highs, like you said, highest it's been since 2008. And really a new high and a strong trend.
Absolutely. As we spoke about last week, inflation numbers, CPI and PPI coming in ahead of estimates. Central bankers still continuing to battle in a very hawkish manner the rising and persistent inflation in the U.S. and around the world. So much to expect in terms of higher rates going forward. Let's take a look at that U.S. dollar chart, Alex. The USD index captured in the ETF UUP, and the persistence and durability of this uptrend is really defying a lot of what the textbooks would tell us. What are we seeing from a trend perspective here? A little lower than our prior highs in September.
Yeah, so not as strong as that rates chart that we saw, but remember, if we stay in this sort of area, then we're making a higher low. This move here a little bit lower than the high here. So what does it look like if you're a technician like we are? It's a triangle, right? We're seeing a coil. We're seeing sort of a symmetrical triangle. We could throw some trend lines on here and see that compression of price. And so there will be a move, either breaking out of a lower bound of a triangle or above an upper bound of a triangle. And we're watching. How do we do that with GoNoGo charts? We watch the zero line, and you can see how, with the exception of this blip here, we've basically been riding the zero line for a couple of weeks, which tells us we've been seeing this reduced volatility, this compression of prices. And you could see that this really is a max squeeze. We just had that blip, but we've been in a max squeeze for a couple of weeks. So the next move out of this squeeze, when the oscillator makes up its mind whether to go back into positive territory or into negative territory, I would imagine will cause price to move in the short term in whichever direction it breaks. If we see this rally into positive territory, then you could fully expect an attack on this prior high. If we break down into negative territory, then we'll be looking at support levels around here as the next ones to watch.
Absolutely. That go-no-go squeeze, the volatility indicator, helping us visualize that tug of war between buyers and sellers on the US dollar chart. And certainly as we see the compression of volatility, tighter range on price movement for the dollar index, we'll be watching at this inflection point to see the break of the oscillator first, whether to the upside or into negative territory, as a leading indicator of potential price action for the U.S. dollar index.
There's definitely more tug of war going on here. If you look back here a month or two ago, you saw quick bounces off the zero line leading to that quick next surge. Well, we haven't had that this time. We're much more deliberation along the zero line here. So we'll watch to see in which direction that breaks.
Absolutely. Let's swing over to a chart of U.S. oil. A lot of talk about the XLE, and we'll get to the energy sector of the S&P 500 for the equity play here in a minute. But what are we seeing in this chart of oil?
Another inflection point. We seem to be talking about a lot of them lately, but we were watching to see if oil would recapture a go trend here when we saw these amber bars, oscillator above zero. Didn't happen, went back to no-go colors, and the oscillator's fallen back to the zero line. So we will now need to see whether this becomes support, which would give price the impetus perhaps to move higher and perhaps break this high, which would probably cause color change. I would imagine we'd see a go color coming in around here if we find support at zero, but it's returned to zero on no-go bars. So if it goes below zero, then that's just confirmation that we're back in this no-go trend.
Absolutely. All right, so these are some of our macro drivers. Let's switch gears. Let's look at some relative strength charts, in particular the GoNoGo the GoNoGo sector RelMap. So we're going to look at the individual sectors of the S&P 500 as they perform relative to the S&P 500 benchmark. Again, we're using a composite blend of trend indicators, but we're looking at that ratio of each sector to the benchmark index, and then considering the trend, just those colors in a heat map format to show us where relative strength lies within the sector groups. Alex, I'm seeing at the top, information technology, consumer discretionary, and communications, all in no-goes. A little hint of constructive behavior from communications on that amber bar here at the end, but certainly growth equities. I hear a lot of commentary about everybody's shopping list for stocks, looking to get back in at things that have been really beaten down. But as trend followers, we don't like to bottom fish. So we want to look at what is outperforming on a relative basis. I'm seeing the XLE, the energy sector, financials, the industrials, and then more defensive rather than cyclical, the materials, healthcare, and consumer staples, all outperforming the benchmark index. Anything else that really draws your eye here on this sector RelMap?
We're seeing an image take shape quite clearly, right? With the middle of this map becoming the outperformance, with, like you said, mostly those sort of cyclical value sectors, energy, financials, industrials, materials, but some defensive too with healthcare and staples. The one thing I think that you try not to be surprised, because you just look at the chart and what does the chart tell you? Well, we were surprised that the consumer discretionary for months staying in an outperforming go trend relative to the index. And now the surprise to me would be utilities. This is a very defensive looking sector map. But the fact that utilities is in a strong no-go and is underperforming the rest of the benchmark, but that's what it is. So I don't worry about it. It's a no-go. Utilities in a no-go.
Well, let's look at the price action from a couple of these sector groups. In particular, let's pull up the XLE, looking to form a bit of if we even jump out to, let's take a look at it on the daily basis, and then we'll look at a weekly next. From a trend perspective, back into strong go trends for the energy sector. And this is on an absolute basis. So this is the price action of the energy sector of the S&P 500. I see lighter volume, but we're still in positive territory on the GoNoGo oscillator. Anything that you'd be looking for in terms of that break above a resistance level and where you're looking for targets?
Well, what's jumping out to me is that I can kind of see how the weekly chart looks by looking at this. On the larger time frame, not really larger time frame, but if you're looking at this chart and looking at more significant highs and lows, after this, we were looking for lower lows and lower highs. And the first time we didn't get that here, this is a higher low than we had over here. And now this looks to me just about, depending on how we close, trying to make a higher high than we had back here. So actually from this no-go correction here, we're actually seeing higher highs and higher lows, which is on a sort of large, if you think about it, bigger picture. On the daily chart that you're just looking at straight right now, you're seeing strong go bars, oscillator in positive territory. And if you throw this horizontal resistance level on here, then we're just about breaking above that. But if you wanted me to go to a weekly, we're going to see how on a weekly basis, we're still in a go trend, and we're seeing that higher low that we were just talking about and a slightly higher high from here. Now, we would like to get back to be higher than this high, to really be able to say that the long-term trend is continuing, but very positive signs that we have the oscillator breaking back into positive territory confirming the continuation that we're seeing in the price trend.
Absolutely. We saw in 2021 the XLE being the highest performing sector group of the S&P 500. And it was really the only trade in the first half of 22, right? It was energy versus everything else. And that cracked in the midsummer. We had those June highs, and we haven't been able to recapture those yet. We hear from a lot of our clients about, I missed the trend. Right. And if we zoom out even further, or just capture a little more of the historical performance of the XLE, we're coming out of a very long-term downtrend that peaked in 2020 at those lows, and so we could just be getting started in what looks like on the weekly basis a little bit of a flag or a pennant from that longer-term perspective.
Yeah, and if you
looking at the monthly, very good.
If you give me a second here, I'm fighting with my mouse, but
all good.
Yeah, the monthly, you can really see how strong this trend has become. Oh no, this is still the weekly. Hold on one second. The monthly didn't do much for me. Let's skip that.
Yep, no problem.
That looks
no problem at all.
Maybe the data's not there on the sector for monthly for that far back.
Sure. Let's check at the financial sector as well. XLF outperforming the S&P on a relative basis, and this is the weekly view, correct?
Yep, this is the weekly.
Yep.
So a totally different chart from energy, right? Like energy is going back to outperformance.
Yep.
Versus the base index as part of a larger go trend for energy, right? Whereas you look at the XLF outperforming the S&P, it isn't doing so well on a pure trend basis itself on the longer time frame. This is a much, very, very bearish chart. No go, lower lows, lower highs, trend continuation, oscillated back into negative territory. So a very different, even though this is what's so important about looking at these in their relative form and in their pure form, because relative to the S&P, we're saying, yeah, we see financials outperforming as well as energy and other, but energy really is truly performing well on a longer term basis.
Absolutely, Alex. Thank you so much for walking through these charts today. And for everybody who's watching on YouTube, make sure you like and subscribe to this StockCharts TV channel. Also check out GoNoGo Charts on YouTube. We post all of our educational sessions, recordings of webinars, and all of these weekly shows as well. Looking forward to seeing everybody each week at the GoNoGo show on Thursday afternoons at 3:30. And stay tuned for an announcement about a special webinar presentation on StockCharts TV that we'll be doing in November. Until then, Alex, be safe, be well, and I'll see you soon.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.